how to survive in life insurance sales during a recession. First things first, guys, if you don't know me, my name's Tristan Dlabik. I don't have anything to sell you. Really, I mean, I don't have any courses, I should say. I don't have to sell you. Life insurance, annuities, if you're interested in those, you're able to reach out. But today I want to get into how to survive in the life insurance sales space during a recession. We've been in somewhat of a recession, a slight recession, kind of like an inflated bubble for the last, 24 months or so. I know there was a spike post-COVID, and there was the COVID recession, but most insurance companies, and what you're going to find is I have all my notes on my phone, so I'm going to read from here. I'll have bullet points, and I'll share my thoughts and ideas, but most insurance companies are about to get smoked. A few people are going to get insanely rich. They're going to get wealthy, and that should be disclaimed as well, that the insurance space is not for everybody. There's going to be a lot of individuals that are not going to make what they think they're going to make. So this is not me claiming or sharing, any type of specific data or information that would indicate you're going to make that money. So just so there's that disclaimer, but I want to share some tips on what you guys should do and what you shouldn't do. So first things first, the 3 recession alarms. So you need to know, and I didn't know this until I would say to the depth that I know now, until probably a month or two ago of doing research. But there's 3 really big indicators of a recession that is about to happen. And the first one would be the yield curve. And to explain that, and I broke this down with chat on how do I explain this if you were 8 years old? Because if you're anything like me, I need things very, very simple and simplified so that I can only, 1, understand it, but 2, teach it, and 3, prepare and build my business plan around that. So the yield curve is the government borrowing alarm. So think of this is when the U.S. is buying treasury bonds. You're basically lending the government your money. So they're buying from us our money. And normally if you lend for 10 years, they pay you more if you lend for 2 years. So obviously that longer loan is typically more incentivized. When it is more incentivized, when it is shorter, that short-term loan, it means the government is hurting for cash, which is pretty obvious now that we are $38 trillion in debt as a nation. But every time this has happened since the 1950s, a recession followed. Think of this like a smoke alarm. It goes off before the fire. So the last time there was a massive, what they call an inversion in the yield curve, and again, that is you have your 10-year long-term loan and your 2-year short-term loan. When it inverts and they are incentivizing you to take the 2-year option, again, this is an indicator of recession. The last time this happened, it was about a year long prior to 2008. And so now I think the current yield curve inversion has been closer to 3 years, almost consecutively. So I don't know if that would be a 3x multiple in regard to the, recession results after that, if it would be 3 times the amount of jobs lost. Again, I am not obviously a financial, I don't have my PhD in finances. I am not an economist whatsoever. I'm just doing some research and I'm giving you guys tips on what's made me money in the insurance space and where I've also lost money as well. The second indicator would be the PMI. That's the Purchasing Managers Index. And essentially that is like a factory thermometer. Think of this like PMI stands for Purchasing Manager Index. It's a monthly score that shows how busy factories and businesses are. If companies are busy, they're buying stuff, hiring people, and growing. So if it's above 50, it means we're growing. If it's below 50, we're shrinking. Right now, it's around 49.1, which doesn't sound like a drastic difference, but apparently it is. It means things are cooling down. So again, like a thermometer, dropping when someone's getting sick, the PMI is an indicator when the economy is shrinking. And the third would obviously be unemployment. So that is a warning light in itself. Strong economy equals lots of job. Weak economy equals job loss starts creeping in. So unemployment is now 4.3% and 911,000 jobs were revised away. So recessions almost always start right after unemployment stops falling and starts rising. It's like the check engine light on your car. It's not broken yet, but something's coming. So when these 3 things flash red, people stop spending on extras, people start protecting what they have. That's when insurance and annuities boom, just like 2008. So it's basically happening again. And I don't think a lot of people take it serious, because if you listen to a lot of or do any research with like Charlie Munger, Warren Buffett, most people move with like a flock mindset. They want to impress their friends. There's ego, there's envy, there's jealousy. and they move kind of with the herd mindset. And so what you'll notice, it's like, it seems now, it's like, I think people know that things are tight, but I don't think the majority is being wise. And whether you're in insurance or not, you should be saving your money because it's loaner money. I think everything I went over just prior to me getting into the tips of surviving in the recession is more so, again, the indicators, things that I'm not as familiar with as I would be insurance. But it doesn't take a genius to know, eggs and gas and, your typical living expenses, rent and things in most areas is far more unaffordable than what it was, 10, 15, 20 years ago, let alone even 5 years. I think the value of the dollar, I know it's in the double digits in regard to how it's decreased just in the last 5 years. So you need to be making more money. The insurance operation, how it works is money is loaned to you. Typically in the life and the health side, they advance you money up front. So that's usually a 9 to 12 month advance. The client pays one premium, and then they give you, the carrier gives you 9 months up front or 12 months up front. That charges back if they don't pay those 9 or 12 months. And then let alone you miss out on the profitability of the residual income that could be there as well. So these are big things to take into consideration. But why it could be good for insurance is when people are scared, they want safety. So right now, annuities are breaking all-time records, over $100 billion per quarter on average. And you can look at the baby boomers, which that would be the more retiree generation right now. This has been going on for the last 2-3 years. So if the light is going off in your mind now, it's like, oh, annuities, you're already behind. You're 2 years behind. Unfortunately, as I was as well. I was working in the captive space prior to getting into the brokerage space. But these are things, it's like the next best time to plant a tree is right now. You know what I mean? Like the first best time was, 5, 10, 15 years ago. You want to be ahead of the curve. But it's still good to educate yourself and figure out what you don't know. And so the second piece to this is fixed products exploded in 2008 and they're exploding again. So again, most people in the insurance space, the majority of the revenue that's generated through the masses are fixed and simplified products. These aren't variable products that are tied to the market. These are guarantees on your death benefit and guarantees on, low rate cash value, accumulating policies, accumulating annuities, different things like that, depending on, again, most of these individuals, the license is just a 215 license. That's the life, health, and annuities, depending on the state that you're in. So there's no variability there. And so there's a lot of, I would say there's contingency based upon when is it going to happen. It's not if it's going to happen, it's more so when are things really going to implode and take that step back. But for the people that you watch a video like this, if you just save your money, and you could really break it down to 2 or 3 things. Protect more clients, save your money, and get referrals so you can generate even more revenue and protect more clients and save more money. You're going to be able to capitalize on the losses when we do enter into a recession and money is tight because, inflation jumps again going into 2026, 2027, and things are just not affordable. It's the people that are prepared, the entrepreneur that is prepared, that's going to take over. That's going to be the guy that's absorbing everybody's team, wondering, well, how's that guy winning more and more? And how's that girl winning more and more? It's the ones that are saving right now and preparing, sitting on cash and being patient. You listen to Warren Buffett, you listen to Charlie Munger. It's patience that beats pretty much most competition. And then it's ego and emotion, that shiny object syndrome that destroys the competition in and of itself. When you start to get too emotional, you start to get too egotistical and thinking to yourself, oh, well, maybe I should do what my friend's doing, and maybe I should get this car and this watch, and you spend too fast. It's stupidity. I think Charlie's got this saying I really like. It's not a matter of trying to be a genius. Like, I don't need to impress you guys. Most of this stuff I'm not an expert in. But the things that I do have expertise in would be the insurance, would be in where I've lost. But Charlie puts it this way. It's like, it's not a matter of you being a genius. You want to get really smart at avoiding stupidity. That's how you get genius results, is be patient, avoid stupidity. And so when you can identify what's stupid, or even another saying they have is, show me where I'm going to die so that way I never go there. So most companies are going to lose, and here's why. and I'll give you 4 reasons. 1, they're going to move too slow. 2, they're going to cut marketing first, which is the dumbest thing you can do. 3, their lead flow is going to dry up, obviously the predecessor with the marketing getting cut. And then 4, their overhead is going to kill them. The people that are out there spending too much money, they're accumulating overhead, they're cutting down on their marketing, minimizing the quality of their leads or even the quantity of their leads. They're destroying their business before the recession even hits, and they're destroying their cash flow by spending too fast. These are the people that are going to get smoked. Now, the independent insurance operators, I should say, the ones that win, they do this. They can pivot fast to what people want because they have the ability to. If you're locked to a product, if you're locked to a system or a structure and you don't have the ability to pivot to multiple different products on what's best for your client, you're going to lose. If you can't control your own lead flow, you're going to lose. When you recruit talent that big companies cut loose or can't afford, that's a way that you can win, but it's also a way that you can lose. If you're stuck in a business model that it can't afford, doesn't have the products, doesn't have the structure, doesn't have the leads, or the freedom and flexibility for a highly talented, essentially an entrepreneur to go out and build the business that they want, you're going to lose. The next piece is when you stay lean, it allows you to scale and capitalize in these downturns. They have this saying, and I don't know if it's Charlie or another financial investor or just somebody along those lines, when the tide goes out, you can see who was swimming naked. And, essentially with the tide going out, with the waters being pulled back, with the curtains being pulled back and exposing everybody in the insurance space, people are going to see more compliance regulations. I made a video the other day in regard to compliance, what you should do, what you should look out for. And I think equally important to following the regulatory codes and laws and what you can do and what you can't do is having cash. People get into insurance, they get into sales, they get money, they spend their money, they flex their money in hopes to recruit people that are attracted to loud, noisy. And I actually came up with a saying the other night I couldn't sleep, and I was thinking to myself, like, the people that have to be very noisy, or any time in my life I've had to be very loud, it was compensation for insecurity. It's like the guy with a really big truck. They always call it the compensator, right? So you think of who's got the compensator in business? It's the guys out there spending all their money on the liabilities, on the materials, and not stacking their cash and realizing if you have cash and opportunities present themselves, you're going to be able to 10x, 20x, or hit that home run. But you'll never, ever be able to hit a home run if you don't have a bat. And think of it in insurance, especially in insurance, your bat is your cash. And that's for every business model. Like, your cash is your oxygen. And if I could sum this entire video up into one thing that I wish I would have done differently going back to when I was 20, 21 years old, and I told this to a couple of guys earlier, we were visiting their office. 1, I would have saved more money and stopped worrying about impressing fake rich people. And 2, I would have taken more risk and stopped worrying about being comfortable and surrounded by fake rich people. And it was all a matter of influence and wanting to impress people that probably wouldn't show up to my funeral. And if they did, they'd show up, eat food, and be back to the fake rich activities, within the same day. And I think for me, the classification of, I don't want to, it's not like I'm attacking, but there's levels of wealth. You've got the poor guys that I would say that are, making a couple $1 million, and the money comes in, the money goes out. They never really do anything else. They get a cool house, they get a cool car, and that's about the sum of their life. But then you've got the guys that also enter into the phase of making a couple $1 million, and they save, and they live below their means, and they continue to scale, and they continue to ask the questions on, how could I lose? How could I fail? How could this get shut down? How could I get in trouble? And they ask the inverted question of, how could this go wrong? And they solve for that, and they build a moat around their business, around themselves, around their families, and they just stay patient, and they stay diligent and disciplined with their money. And that's the guy that you wake up one day and you're like, wow, he's a genius. When really they were just patient and they were asking the right questions. There's so many things you can get right. And I think there's a few things you can get wrong, and it's a matter of solving for what to not do. Like, what absolutely should we not do if we don't want to lose our money and our butts in this business, in our relationships. It's a super simple way that you can kind of go about it. 3 recession plays that you guys can utilize. Lead flow. You want to own the faucet, own the leads. Whoever owns the leads owns the business. You know what I mean? Lead flow is cash flow. And I also tell people lead quality is life quality. I don't believe in burnout. I believe people burn out when they're calling people that aren't interested in their product. And then you'll have an upline trying to convince you that you're going to develop your character, trying to convince people to buy something they're not interested in. There's 8 billion people in this world. I promise you, there's 100 people this year that want to buy your product, and they want to buy it at a premium price, and they want to do business with you next year. Minimum. You know what I mean? Like think of it. There's 8 billion people in this world. And if you're selling life insurance in the USA, there's 300 million people that you have access to. And if you don't have access to all 300 million, again, you're limiting yourself to a company structure that's limiting your territory. If they're limiting your leads, like, do the math. And it's not an opinion, it's just reality. And I think very intelligent people, they deal with reality. And I think the less intelligent people, and myself, anytime I've made dumb moves, I wasn't dealing in reality. I was dealing in a fantasy world, whether it was a super negative fantasy world or a super positive, optimistic, everything has to go right or everything has to go wrong. It's just looking at the data and building your life in correspondence to that. So you want to own the lead flow. 2, cash stacking. We talked on that. 3, consolidation. Buy when others are bleeding out. So what does that look like? When they panic, you're going to build. When everybody's spending, you want to save. It's when nobody's spending that you start to look to spend. You start to look to where are the deals at, where are the teams at, who can we offer a better team to, who can we offer better resources, what can you do for everybody else that they can't do for themselves or their upline's not willing to do, which you'd be very surprised. There's so many greedy uplines out there in the sales world. You can do a lot of good things. So the biggest thing when it comes to recessions, guys, and surviving in the life insurance space, like I told you before, you got to sell. You've got to sell the right way. You got to make money. You have to save your money. And you have to constantly be asking the questions of how could this go wrong? How could this, blow up? How could it explode? Question the business model that you're in. You should stay paranoid. You should question the people that you're following that are influencing you. Are they where you want to be 20, 30 years from now? And they're going to use the same language. The manipulators, the really good manipulators, are going to tell you to avoid reading books on manipulation. They're going to tell you the 48 Laws of Power is the book of the devil. They're going to tell you that if you just wait 20 or 30 years and you keep making your upline as his overrides, that one day you'll have a life like him or her. Do your own research. Well, what do you want in this life? If it was so good or if it was so bad, whatever they're telling you, ask what is being hidden. Are the leads being hidden from you? Is the compensation being hidden? Solve for what's being hidden in addition to solving for how could this go wrong, and you're going to do just fine.